London formalized its stock exchange in 1773 after decades of traders just kind of hanging out in coffee houses, doing deals. Stimulants and trading have gone together like peanut butter and jelly for hundreds of years. This explains a lot about both asset classes.
Yeah, I mean, we went from coffee houses to trading floors to guys in fleece vests staring at 12 different monitors. And the stimulants changed to Zins and Celsius. The chaos and short selling definitely did not.
America was watching. Not to be outdone by its big brother in London, the Philadelphia Stock Exchange opened in 1790, the first of its kind in the new country. Then 2 years later, New York. The NYSE was founded under a buttonwood tree by 24 brokers signing the Buttonwood Agreement, a 2-sentence pact made outdoors near 68 Wall Street.
This is where the Buttonwood Agreement was signed under a buttonwood tree. There are no trees anywhere.
And they committed to trade only with each other at fixed commissions of 0.25%, or as the experts like to say, 25 bips. Leonard Bleecker, a prominent merchant whose family name still graces Bleecker Street, New York, was one of the 24. Alexander Hamilton's Bank of New York was one of the first companies listed. Serious people doing serious things informally outside in the seriously bad Northeast weather.
So basically your typical Buffalo Bills tailgate.
Minus the folding tables. You see, the whole point was to move trading from the street into a private club. A club with fixed commissions, pre-approved stocks, and no outsiders. If you wanted to trade, you needed one of the approved brokers. An auctioneer would read off reputable stocks one by one. A small but big thing to call out, this moved trading from a side quest to a profession, which sounds obvious now and wasn't at all then.
By the way, Wall Street has spent 230 years making that original deal worse for everyone that's not in the club.
It's a big club, and you ain't in it.
Stocks at this point were for two types of people: outright speculators and people trying to take control of a company, kind of like that meme stock CEO.
I don't understand your question.
Not a lot of tertiary use cases. The market was small, the participants were wealthy, and then William Dewar showed up and reminded everyone why we can't have nice things. Dewar was the former Assistant Secretary of the Treasury, friend of Alexander Hamilton, an architect of America's first major financial crash. And the winner goes to. He used massive loans and insider knowledge in a failed attempt to corner the market on U.S. debt securities and bank stocks. This guy spread rumors of bank mergers and created a fake bank called, wait for it, the Million Bank to manipulate prices.
Yeah, that's definitely not a shady name at all for a bank.
The market sold off 25%. Dewar ended up in debtor's prison, which I thought was just something in the movies. And as Ron Burgundy would say in another movie,
boy, that escalated quickly.
By the way, the country had only been trading stocks for roughly 3 years. The Buttonwood Agreement was a direct response to this. The 24 brokers moved behind closed doors, like we said, to make sure all traders were reputable, unlike that guy Dewar. In 1817, they drafted a constitution, rented indoor space at the Tontine Coffee House.
We are not in front of the Tontine Coffee House. We're in front of a Blue Bottle, which I'm pretty sure is a venture-backed coffee chain.
It wasn't officially named the New York Stock Exchange until 1863, after going by various names for nearly 100 years. Most people just called it the board because prices were written on a board. Cue the Pusha T.
Ballers, I put numbers on the boards.
Damn, I've been waiting 3 years to get a Pusha T reference in there. Mission accomplished. The first 50 years of the New York Stock Exchange were mostly government bonds and bank stocks. It was a nice start. Then came the railroads, and everything changed.
When I ride the train, I think about depreciation and amortization.
Because building a transcontinental rail network is not a mom-and-pop operation. You need capital at scale that local merchants and farmers simply cannot provide. Roughly 75% of railroad funding came from private loans and stock offerings rather than the government. The New York Stock Exchange became the mechanism that let American railroads tap European investors, people who had never set foot in Ohio and were willing to fund 1,000 miles of track through it. This required two things: a market liquid enough to make the investment feel reversible, and accounting language sophisticated enough to explain what they were buying.
I think I get what you're saying, that railroads basically invented modern accounting.
Yes, depreciation existed because tracks and locomotives wore out over decades, and someone had to account for that. CapEx versus OpEx existed because building a rail line and running one are fundamentally different financial activities. This is a good one. Cost per ton mile was invented as a metric, and I love metrics, especially the weird ones, because investors needed a way to compare efficiency across routes. Necessity is the mother of all invention, including financial metrics. So in many ways, your month-end close has a 19th century railroad to thank. This was the precursor to GAAP accounting as we know it. By 1860, U.S. companies had laid more than 30,000 miles of track.
It reaches from the Twin Cities of the North Star State to the Gulf ports of Houston, Texas City, and Galveston of the Lone Star State.
More than the rest of the world combined. Telegraph lines followed those tracks, letting news flash between financial hubs in real time, which meant you no longer needed a stock exchange in every city. The exchanges in Albany and Buffalo became redundant. Sorry, Buffalo.
Thank God they still have their tailgates.
Oh, fun side story. Jay Gould, one of the most famous bears of the era, was called the Mephistopheles of Wall Street, a really gloomy name and an even harder word to spell. He'd publish vicious rumors about companies and newspapers he owned to drive down their prices. Then he'd buy. This was one of the early examples of sellers weaponizing media to move markets. Not completely unrecognizable behavior by today's standards. So let's talk about information again. Charles Dow, financial journalist and first editor of the Wall Street Journal, launched the Dow Jones Transportation Average in 1884. He took 9 railroad companies, added up their stock prices, divided by 9, and presto! It was simple division, but that wasn't really the point. The point was to create an onboarding ramp for people who weren't familiar with individual stocks. Now they could speak more generally and get a litmus test on if the market was going up or down. It pulled a whole new swath of people into the mix. In 1896, Dow expanded the index into the Dow Jones Industrial Average. 12 companies covering heavy industry, including sugar, tobacco, and oil. General Electric was one of those originals.
To new victories in General Electric's never-ending quest for better ways of living.
And Edward Jones lent his name to the whole thing, despite reportedly playing no active role in creating it.
Yeah, sounds just like a group project from 7th grade.
Well, since I have the platform to say this, I want my group project teammates from Miss Blessington's 8th grade history class to be my pallbearers at my funeral someday so they can let me down just one more time. The second industrial revolution brought about the rest of the giants we still recognize. Companies like Procter & Gamble, Pfizer, American Express, which, by the way, started as an express mail business before anyone thought to put it on plastic. The market was growing, the participants were multiplying, and the information the exchange was generating was becoming arguably just as valuable as the capital getting allocated. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI-native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations, woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me.